authorizing the city manager to execute a non-binding letter of intent for Madison Barquette, Madison Bay Street, LMCC, to pay off the promissory note. Well, that sounds like good news.
Good evening, Mayor, City Council members. To start off, just background on the promissory note on Site A. It was executed pursuant to the terms of September 1999 Disposition and Development Agreement with Bay Street Partners for the redevelopment of Site A as the Bay Street Mixed-Use Project. And the developer funded the purchase price of Site A through an upfront down payment of $1.8 million and executed a promissory note with the agency for $23.7 million. This chart shows the principal repayments on that promissory note starting in calendar year 2010 and ending in 2027 and ramping up from $500,000 annual payments to $750,000 to $1 million in 2022 to 26, and then in 2027 a balloon payment of the outstanding balance of the principal. The interest payments had two components. The first are fixed interest payments of $250,000 annually, and the second component is a participation interest payment based on a formula of 25% of project cash flow above a preferred return to the developer of 11.5%. And the preferred return is calculated as the project's net operating income divided by project costs, which are approximately $170 million. So in order to get a participation interest payment, the net operating income from the project would need to be in excess of $19.5 million. It has not exceeded that threshold since Bay Street was developed, opened for business, and it's not projected to in the future, so no participation interest payments are included in our projection. The adjustments to the principal balance of the note are listed here. There was a deduction of $3.3 million in a one-time down payment in 2002. There was an addition of $570,000 for developers' public improvement costs for sewer and street widening. An addition of $375,000 equal to 50% of to a deferral of 50% of the fixed interest payment for 3 years. A deduction of $2 million for reimbursement of developers' remediation costs that were not covered by insurance, and then a deduction of $1 million that have been the principal payments made to date. So this table here shows you, starting with the beginning promissory note face value, taking out the deductions and adding the additions, the total principal balance today of the note is $18,345,000. And this table here shows how that $18,345,000 would be paid down over the remaining term of the note along with the fixed interest payments. So what we need to do now is develop the discounted present value of future cash flow of the note. That is how a note with a stream of revenue is taken to a present value and valued. And just as a little background, as definition on the present value from Wikipedia is that it's a future amount of money that has been discounted to reflect its current value as if it existed today. So the present value is always less than or equal to the future value because money has interest earning potential. So $1 today is worth more than $1 tomorrow. The discount rate reflects the time value of money and a risk premium. So the time value of money is the risk-free rate, and the risk premium reflects whatever risk is associated with that development. So looking at what the risk premium would be for the promissory note, we based the risk associated with the shopping center cash flow. And the best indicator would be the capitalization rate used in shopping center sales, which is used to convert a stabilized year net operating income to value. So through research, we found that the capitalization rate of large shopping centers similar to Bay Street, which are regional malls that are market dominant, that are located in major metropolitan statistical areas with sales in the range of what Bay Street has, a discount rate applied to that is approximately 7%. So 7% applied to the cash flow yields a net present value of $11.5 million. So these are the proposed terms of the promissory note payoff. The amount of $11.5 million, an all-cash payment. The developer would continue to make interest payments until closing with no adjustment in the note payoff amount. The successor agency shall obtain approval from the Oversight Board and from the State Department of Finance on this agreement, and would provide assurance to the developer of the consent. And the closing would occur in no event later than December 31st, 2013. There would be no brokerage fees, and at closing, the successor agency would deliver the note marked paid in full and would release the lien on the title. And the developer would pay the escrow fees and third-party legal expenses. So what we're recommending is that tonight you approve these proposed terms and direct the city manager to execute a letter of intent with the developer. The benefits from this transaction will result in a one-time upfront payment to the city equal to 22% of the total. So that's the city's share of the distribution of that $11.5 million to all the taxing entities. So that'll result in $2.5 million upfront to the city that can be used for a capital improvement projects. It is a one-time payment, not an ongoing payment. It will also relieve the city of ongoing administrative responsibilities tied to the note, which are tied to receiving annual statements of net operating income and audits. And also removing the lien will facilitate future refinance or future sale of Bay Street. So without that encumbrance on the title, Bay Street should be able to get better interest rates in refinancing, therefore be able to pull more funds out to reinvest in the center. All of these will have positive fiscal consequences for the city. So the next steps are, if the city successor agency authorizes the city manager to execute the letter of intent, the parties would proceed to draft a note payoff agreement, and then that note payoff agreement would come back to the successor agency for approval, and then to the Oversight Board for approval and execution. And that's the end of my presentation. Madison Marquette's here if they wanted to make a brief presentation as well about the proposal.
Want to come up?
I'll be as brief as I can. Mayor Brinkman, council members, thank you for considering our proposal this evening. We've been working with staff to figure out a way to pay off Bay Street's promissory note with the successor agency. We initially offered $11 million, and staff countered our proposal with $11.5 million, which after much discussion and consideration, we accepted. The promissory note was executed in 2002 and runs through to 2027. It's made of annual fixed payments with a balloon payment at maturity, which Helen's already discussed in her presentation. We looked at comparable projects with similar risk profiles to derive an acceptable discount rate or interest rate that would put a fair current value on the note. The discount rate is based on the concept of present value, where $1 today is worth more than $1 tomorrow or 15 years later, as a result of inflation, opportunity costs, and risk. By industry standards, Bay Street is called a Core Plus project. There is some downside risk from tenant rollovers and lease expirations, with the upside potential of Phase 2. To release these spaces to new tenants, this would likely result in lower rents as compared with the above-market rents that the current tenants are at. We have used the same discount rate as applied to similar projects with the same risk. Paying off the note has mutual benefits to both the city and Bay Street. The city would receive 22% of the proceeds, or $2.5 million, in a single lump sum payment. The city would get a much more meaningful amount of money to use for its immediate priorities, as well as reduce the administrative burden on city staff. For us, paying off the note will make it easier for us to refinance the project. The existing interest payment schedule has discouraged new lenders because of the unconventional nature of this note. Each time we refinance, we are better able to reinvest the proceeds back into Bay Street and continue to upgrade the project. Bay Street contributes 23% of the city's total sales tax revenue. And each time we upgrade the project, we bring in more, every time we upgrade the project, we potentially bring in more opportunities to grow the project's sale tax revenue contribution. We ask that the successor agency approve the terms in the letter of intent to pay off this promissory note. Thank you.
Okay, thank you, Cedric.
So I am available to answer any questions you might have.
Is there anybody that has any comments on this item before we, council? No public comment? Okay, yes.
I have a quick question. Helen, could you go back? It was one of your earlier slides that showed the fixed interest payments, I believe.
Here?
Yes. So my question is, the interest payments are included in the total face value of the 23.7 million. Does that include not only the principal of 18?
The interest payments are not included in that face value. This does not reflect the entire. Well, here, we'll go back a little bit further.
Maybe it was an earlier slide I was thinking of.
Just get back to this. Okay, so here's the 23.7 million, right?
Right. That was at the initial
And so
outset.
here's all of the payments that were made against it. So what the
Towards the principal, but not the interest payments, correct?
right, there's no interest payments in here.
Okay.
So this is the balance. The principal balance right here is 18,345,000.
But if we did not have a payoff of the note and we went forward, eventually, with all the risk and time and inflation and everything, the 18.3 million would be repaid, plus the fixed interest payments of 250,000.
That's correct.
per year.
But what
What's
tried,
that total amount?
we tried to explain is that the value of that in the future is less than that today.
But it's not the value. I'm just trying to
So
make a
here's the
distinction.
total. So the future payments here are 10 million plus 3. It doesn't count the 8. That's the part that doesn't. So
Oh, I
here's
see.
the balloon payment right here, right?
So it's 10 and a quarter plus 3.5 plus
the total
8.
interest is 3.5 million. So they're paying off the principal plus 3.5 million in interest. That's the easy way to think about it.
But that's not factored into the net present value today.
It is, because this total cash flow right here is principal plus interest, right? And then it's discounted.
Okay, so it is included. The interest amount is included in the number that was used to then calculate the net present value.
Correct. Correct.
Because I thought you started with the 18.3.
Yeah,
Here's
that's,
the
staff report.
18.3 right here.
So my question, though, is it the 18.3 that is now with the net present value 11.5, or is it 18.3 plus 3.5?
It's
with the net present-
18.3 plus 3.5.
Okay, that I just wasn't clear on that.
okay. Do you have any questions, Jack?
It's the $21.8 million figure.
I just don't remember seeing the $21.8 million figure in our report. I feel like maybe I just missed it.
This was an attachment in the staff
Okay.
report.
Okay.
Yeah, I have a question, and I spoke with Pat about this, but if I could also just get clarity again, and also maybe for the public to understand this as well, because it's something I was not clear on. I'm on page 38 in the agenda. It's page 10 of the DDA under proceeds participation payments. If the developer receives any proceeds from the sale, lease, or joint venture of all or any portion of the site that is not part of the parcel of the site upon which the retail improvements will be constructed, including but not limited to any air rights, developers shall pay agency an amount equal to 25% of such proceeds, up to a maximum amount of $2 million. I guess one of the things I'm trying to understand there is, in addition to looking for more freedom and to not have an encumbrance on the title, is this, does this say that if the the parcel is sold, if the air rights are sold, that then the agency at a future time would be entitled to 25% of such proceeds as well, on top of the repayment of the promissory note? Or is this something that's wrapped into,
This is part of the promissory note.
that is part of it? So it's not in addition to, that if it's sold, that we would,
Right. That provision was anticipating the sale of the housing air rights parcel. So you have the housing above the retail that fronts on Shellmount Street. Those parcels were sold, and so that's what this was anticipating. So when those were sold, there were payments made.
there were payments made already? Okay, so this is just documenting what happened at that point.
Yeah. So this
Okay.
doesn't have any application going forward.
Okay, all right, thank
But
you,
it
Mike.
did occur as spelled out here in the participation
Yeah,
agreement.
because they did sell off those air rights parcels for housing.
Okay, thank you.
Okay. Ruth?
I don't have any questions.
Nora?
I don't have any questions, but I do have a comment. As the gentleman from Bay Street mentioned, this was a very creative promissory note. And without this promissory note, there would be no Bay Street. It was very hotly debated at the time. It was very controversial. But one of the proofs of the success of the creativity of the manager at the time and at the redevelopment agency is that we have Bay Street there, adding very healthily to our sales tax, as you mentioned, 28%, 27%.
23, yeah.
I certainly want to express my gratitude to the staff, both the city manager, attorney, and Helen, on coming back to the table with this and finding a solution that will free up the city from this, give us a cash infusion, which we certainly need for our capital improvement plans, and will also free Bay Street to Madison Marquette to be a little more nimble in the market, whatever it is that you're going to be doing. With those remarks, I would move this resolution.
I have one more
Yes.
question. We still are looking at a series of approvals, though, right? This goes to the Oversight Board and then to the Department of Finance, right?
The actual agreement will come back to the successor agency for approval, and
Okay.
then that agreement goes to the Oversight Board, and then it goes to the Department of Finance.
Okay, thank you.
So this is basically,
Okay.
I have two more questions. One is, when we receive current payments, annual payments, is that distributed to all the taxing entities at this time?
it would be yes.
It hasn't happened yet, or it has?
Well, we received one payment this year. I'm not sure.
Yeah, I mean, it goes into the
The
pot of money, and
Right.
it gets, I believe it got taken back out as part of the due diligence review.
Right.
Okay.
So it gets captured there.
Okay, thanks. And then, as for the rate of 7% that was chosen, it talked about a 6 to 8% range. And I'm curious what the thought was about settling on the 7% rather than going with a 6%, which would be more favorable.
Mostly because it was a midpoint in a range that we've identified. It made more sense to go right in the middle of that range.
So it was a point of negotiation.
Okay, thank you.
Well, we have a first and a second, so I guess,
Call the question.
yeah, call the question.
Councilmember Atkin.
Aye.
Councilmember Davis.
Aye.
Councilmember West.
Aye.
Vice Mayor Asher.
Aye.
And Mayor Brinkman.
Aye. Okay.